In the field of business, the proverb "cash is king" is something that you might have heard. However, what happens if you do not have sufficient funds to cover all of your expenses? What would you do if your business continues to struggle to expand while operating at a loss year after year? Therefore, does this imply that you ought to quit and file for bankruptcy? This is not always the case. There are numerous examples of prosperous businesses that have been able to continue operating even though they have been losing money for an extended period. Some are well known to the general public, such as Uber, Tesla, Spotify, and Amazon. What secrets do they keep? And what are some things that you may take away from them? In this installment of the episode of the week, I will discuss some of the insights that I have gained from the episode titled "How Unprofitable Companies Stay in Business," which was uploaded to the YouTube channel CNBC. This episode discusses how certain companies can maintain their enterprises by taking on additional debt that they most likely will never be able to repay. They are referred to as zombie companies by economists. Companies that are considered to be zombies typically invest less, grow at a slower rate, and hire fewer employees as compared to their lucrative counterparts. On the other hand, they also possess several benefits that enable them to endure and even grow in the market. Here are some of the most important things that may be learned from watching the episode. An appetite exists among investors for businesses that are not profitable. Unprofitable businesses can continue operating for several reasons, one of the most important of which is that they can attract investors who are ready to bet on their potential for the future. Unprofitable businesses do not discourage investors from investing in them. At this point, the percentage of companies in the United States that have reported losses before going public is at its greatest level since the dot-com boom of the year 2000. Before their initial public offerings, 76% of the companies that were listed in the previous year were not profitable in the year before their offers. Investors are seeking prospects for growth, particularly in the technology industry, where many shareholders place a high value on growth and frequently feel more at ease, even if the companies they invest in are not making enormous margins. Amazon, for instance, is the second most valuable corporation in the world based on market capitalization. Even though it has been relatively profitable for the majority of its history, Amazon stock is extremely popular among investors. Nonetheless, the company's overall profit over the previous 20 years is insignificant when compared to the profits of other highly valued corporations in the United States. Companies that are not profitable have adopted a new business model. Unprofitable enterprises can continue operating for several reasons, one of which is that they take a different approach to the management of their operations than traditional organizations that are focused on making revenues. Developing a customer base that is loyal to the company, increasing its market share, and disrupting existing sectors with novel products or services are frequently the primary focuses of businesses that are not profitable. Additionally, rather than paying dividends or purchasing back shares, they reinvest the majority of their profits so that they can continue to grow their company. In this manner, they can generate economies of scale, network effects, and competitive advantages, all of which will eventually lead to profitability in the long run. As an illustration, Tesla has been underperforming financially for several years, but the company has also been making significant investments in areas such as research and development, production capacity, and customer service. As electric vehicles and renewable energy are anticipated to become enormous businesses in the future, Tesla's objective is to establish itself as the industry leader in both of these areas. Companies that are not profitable have the opportunity to participate in government programs. A third reason why businesses that are not profitable can continue to operate is because they are eligible to receive assistance from a variety of government initiatives that are intended to provide assistance to small businesses and to promote the economy. For instance, during the pandemic caused by the coronavirus, a large number of businesses that were not profitable were able to apply for loans through the Paycheck Protection Program, PPP, which was established by the Coronavirus Aid, Relief, and Economic Security (CARES) Act. During the crisis, the PPP offered loans that could be forgiven to companies that had less than 500 employees and were harmed by the crisis. There are a variety of charges that could be covered by the loans, including rent, utilities, and payroll costs. During the lockdowns, the PPP assisted a great number of businesses that were not profitable in remaining in business and in keeping their personnel. That being unprofitable does not necessarily mean that one is unsuccessful is something that can be seen here. Unprofitable businesses have several options available to them that allow them to continue operating and even manage to surpass their lucrative competitors. On the other hand, there are a few dangers and difficulties that are faced by businesses that are not lucrative. As an entrepreneur who is not making a profit, you should steer clear of the following pitfalls. Don't put too much stock in your debt. Taking on debt can be a beneficial tool for financing your growth and innovation, but it also has the potential to be a double-edged sword that can be detrimental to your financial health. Your interest expenses will increase, your cash flow will decrease, and your flexibility will be restricted when you have debt. You may wind up defaulting on your responsibilities and losing your assets if you borrow an excessive amount of money that you are unable to repay or refinance. There is also the possibility that you may have a more difficult time raising further capital or selling your shares at a price that is beneficial if the market conditions alter or if the sentiment of investors shifts. You should therefore exercise caution about the amount of debt you take on and how you use it. In addition to this, you should have a particular strategy in place to reach profitability and positive cash flow in the not-too-distant future. Make sure you don't overlook your rivals. Even though unsuccessful businesses could have a first-mover advantage or a distinctive value offer, they might also be confronted with intense competition from other people operating the market. Some of your rivals may be more advanced in terms of innovation, efficiency, or profitability than you are. There is also the possibility that they have more resources, more consumers, or more patents than you have. Should you fail to keep pace with your rivals, you run the risk of losing your market share, your brand awareness, or your advantage over other businesses in your industry. It is for this reason that you should always keep an eye on your rivals and the techniques they employ. In addition to this, you should make consistent improvements to your products or services, reduce your expenses, and boost the level of satisfaction your customers feel. Take care not to ignore your stakeholders. Companies that are not profitable may have a dedicated fan base or a visionary leader. Yet, if they fail to deliver on their promises or expectations, they may also alienate some of the stakeholders who have invested in the company. Your employees, your customers, your suppliers, your creditors, and your regulators could all be considered to be stakeholders in your organization. You may be subject to litigation, boycotts, strikes, or fines if you do not treat them well. Additionally, if you are unable to connect with them efficiently, you may have the potential to cause uncertainty, mistrust, or animosity. Because of this, you should always show respect to your stakeholders and get involved with them. In addition, it would be beneficial if you were trustworthy and forthright about your performance, your objectives, and the difficulties you are facing. In conclusion, although a company's lack of profitability might not directly result in the company's demise, it is not a condition of circumstances that can be maintained over time. As an entrepreneur, you should try to achieve profitability while keeping in mind the dangers that come with taking on debt and placing an excessive amount of dependence on valuations. Did you like it? Tell us what you think of the video in the comments section below. And don't forget to subscribe to our YouTube channel for more interesting videos.